Loads of investors are asking, how does the stock market affect real estate? And if you're thinking about investing in real estate and you see the stock market go up or down, you may be asking the exact same question. Hey there, my name is Mike Fritz. I'm the founder of Titanium Capital Investments and the Multifamily CEO System. My greatest passion is helping people just like you create financial freedom with multifamily real estate. And in this video, I'm going to walk you through the 3 ways the stock market can affect the real estate market. Let's get started. The number 1 way the stock market can impact real estate is by the interest rates of loans. The number 1 thing banks are looking at when they give you money for a real estate project is your ability to pay it back. They may look at your net worth, they may look at your income, your tax returns, how much money the property's making. They look at all these different aspects to see your ability to pay back the loan. But one of those things, if they're looking at your income, is how stable is your job. And a stock market can tell us a little bit about where the job market is going to go. So if the stock markets are going up or down, we may see an increase of employment or a decrease of employment. But a bank has a lot more confidence in a strong stock market to give out money because they assume jobs are more secure. So as you know, in a loan, most commercial and investment loans, you're going to make a down payment and you're going to get the bank to pay for the rest. That down payment, the amount of money that the bank requires you to have down, and the interest rate may be dictated by a falling or rising stock market. Whereas you used to be able to get a loan for 20% down, they may raise that to 30% down. Well, when you have to come up with an extra 10% on $1 million property, that's another $100,000 you're going to have to bring to the table to bring that property to the finish line. So when interest rates go down, so does supply. But when interest rates go down, demand goes up. And when supply goes down and demand goes up, that's a perfect scenario for increased prices in real estate. Now, a stock market can dictate that fall and rise in supply and demand because when interest rates go down, demand goes up and supply falls with interest rates. And if the stock market is rising and falling and the bank is dictating their interest rates based on that, it can have an indirect correlation to your real estate deals and the type of real estate deals you're looking to get into. With less volatility in the stock market, the bank feels more comfortable in your ability to pay back the loan. And that is probably the most strong metric you can use when looking in real estate because your debt service has so much to do with how well the property will perform. A stronger debt service or a better loan will give you the ability to make more money on that project. If the bank is a lot more stingy and wants you to bring more money to the table and charge you a higher interest rate, that's going to cut into your return. So you have to make sure when you evaluate your deals that you make sure you're putting that in there to make sure you don't assume you're going to get a loan for less and then end up having to pay more. But the number 1 way the stock market impacts real estate is through the perception of consumers. You see, people that are spending money, when the stock market starts to go down, they freeze, and their perception is that we're headed into an economic crash. So therefore, they stop spending. They might stop buying luxury items like RVs and boats. They might stop investing in real estate because they want to see what's going to happen in the market. They may pull their money out of the stock market, which again, because now there's more supply, the price of the stocks go down. So the more people that pull their money out of the stock market, what happens? The value of the stocks go down because demand has gone up and supply hasn't. This is the idea. So as supply and demand goes up and down, it's going to change things. Well, what changes supply and demand in the stock market is people pulling their money. But what changes them pulling their money? It's their perception. When they see the stock market go down, they pull their money. They don't wait or change it to a new stock that may be rising. We saw this very clearly in the COVID-19 pandemic. We saw some stocks go down while other stocks skyrocketed. Stocks in restaurants obviously plummeted. Stocks in tech companies skyrocketed. We saw Zoom absolutely go crazy while we saw stock in McDonald's fall a little bit. But here's the idea of a K-shaped economy. Some goes up, some goes down. And here's the idea behind this is when stock markets are volatile and going up and down, it changes the perception in the mind of consumers. And so because they stop consuming, the economy is more sluggish. They might not buy as much real estate, meaning it shrinks the amount of buyers, meaning supply gets out further from demand. That's a problem. When that gap gets closed up and supply and demand are equal or supply is ahead of demand, then we see prices really start to fall. But a perception in the mind of a buyer or a consumer is not direct correlation, it's indirect correlation. Some consumers may be buying more in a recession. I know I do. Anytime I see things start going down, I leverage that time period, get better prices on properties, and buy as much as I can. So it really depends on the consumer. But consumers at large, their perception takes a hit in the midst of a stock market. But consumers in general, their perception of a falling stock market is to freeze and save rather than invest and move forward. Before we go on to the last thing I want to talk today about the stock market and real estate, make sure you subscribe to the channel and also turn on that bell notification so you get notified every time we do a video, which is every single weekday. Also, smash that thumbs up button. That helps us get our message to more people, help create more financial freedom in people and their families. And the third thing that happens in relationship from a stock market fall to real estate is it becomes a buyer's market. For example, when stocks go down, perceptions change. When perceptions change, behaviors change. When behaviors change, especially buying behaviors change, supply goes up. When supply goes up, demand goes down. When demand goes down, prices go down. And when prices go down, it's a buyer's dream. So you ask me how the stock market impacts real estate. Sometimes it impacts it very well, because if the stock market can push real estate down, you're going to lose your value. The properties you own are going to take a hit, but the properties you can buy, it's going to be a buyer's dream. It's going to be the time to acquire properties, not the time to sell properties, time to hold on to properties and let that come back up. But it's the time to buy as much property as possible. So when a stock market goes down, there's two things I think of. Number one, let me see where my properties currently are. I'm not looking at the stock market as much as the economy overall. For example, in a buyer's market, all that means is there's more supply than demand, right? Well, in real estate, that's kind of hard to do because there's not a lot more real estate being built right now. So we have a lot more buyers thrust into the market and supply isn't really going up. And until people start selling more homes, we're going to really have a supply-demand issue. Currently, we have 4.5 million more buyers than we have homes. So even if we see a load of foreclosures come to the market, that gap is going to have to change, and that gap is going to have to shift and close up for us to see a tank in the real estate market, which I really don't believe is going to happen. But this also underlines why you should be investing not in fix and flips only and wholesaling. You should be investing in buy and hold real estate that you can rent out, because while you lose your value, you don't lose your cash flow. So you can still make all the payments. As long as that property can continue to produce cash, you can hold on to that property until it increases in value. In fact, one of my investors just came to me. He's invested over $800,000 in our deals, and he just came to me in the middle of a 1031 exchange, and guess what happened? He bought a property in 2007, and it tanked, lost all his value. Bought a property for $1 million, went down to $500,000, lost half of his value. And it took 13 years to get his value back up, and this year he sold, and now he invested that money into our deal. But what he did was he just held and waited patiently and then sold it off as it reached a value that made sense for him to sell. So if the stock market's going down and it does impact real estate, becomes a buyer's market, buy, just don't sell during those times. For the power tip for stock market and real estate, look more at interest rates than you do the stock market, because interest rates will tell you a lot about a market. If interest rates are going down or going up, with interest rates falling, more people buy. Even if interest rates go up a little, but not a lot, people aren't going to stop buying for 1/4 or 0.5%. Now, if it goes from 4 to 7, that will definitely slow down the market. So that's why we want to look at those interest rates and see as they climb or fall, that will give us the ability to know where the market's headed. I also want to give you a free gift today. I want to give you my free 60-minute multifamily masterclass. This is a training I put together that I'm really excited about because it can help you get into real estate without any of your own money and start producing cash. So even if you do see a crash, you're going to hold on to your money. Go into the description and you'll see freemultifamilymasterclass.com. Go ahead and click that link. You'll be taken straight to the training. I'll see you there.